Welcome to another episode of Unpacking Transfer Pricing, where aims to demystify complex business concepts for the curious mind. Today we will discuss the Chapter 2 of the OECD Transfer Pricing Guidelines 2022. A detailed audio-only description link is provided in the comment section. As always, this is not a professional advisory, and hence listeners should not rely on this alone to make decisions. For technical matters like transfer pricing, one should always reach out to the TP practitioners. So, without further ado, let's begin. Transfer pricing methods are divided into traditional transaction methods and transactional profit methods. Traditional methods, like comparable uncontrolled price, resale price method, and cost-plus method, focus on direct price comparisons. Whereas profit methods, such as transactional net margin method and profit split method, emphasize on profit distribution. The choice of method depends on the specific circumstances, detailed functional analysis, case specifics, to ensure arm's-length pricing in any controlled transactions. Selecting the most appropriate transfer pricing method involves evaluating strengths and weaknesses, analyzing the true nature of the transaction, and assessing information availability. Consider the degree of comparability between controlled and uncontrolled transactions. While traditional methods are preferred, multinational enterprise groups can use other methods if they satisfy the arm's length principle. Selection should be case-specific, not rule-based. Traditional transaction methods, including the comparable uncontrolled price, resale price, and cost-plus methods, establish arm's length pricing by comparing controlled and uncontrolled transactions, especially their prices in a comparable circumstances. Comparable uncontrolled price is most direct, ideal for physical product transfers with reliable data. Resale price suits resale and distribution operations where negligible value is added to the goods and where sales is your value or profit driver. While cost plus applies to stable manufacturing or services, adding a profit margin to costs makes more sense since cost is your value driver. The comparable uncontrolled price, or CUP method, is the most direct and reliable for establishing arm's-length pricing by comparing controlled and uncontrolled transactions. It requires that differences do not materially affect prices or can be adjusted accurately. Practical examples include adjusting for market differences in coffee beans or delivery terms like cost, insurance, and freight, CIF, versus free on board, FOB. This requirements for using a CUP method is stringent but highly effective and best for defending one's pricing policy in front of the tax administrators. In commodity transactions, the CUP method requires adjustments for material differences. Quoted prices from exchanges or agencies reflect independent agreements. Key considerations include economic comparability, contractual terms like delivery and insurance, and the pricing date. Identify controlled transactions, find similar uncontrolled ones, and compare prices. If pricing date evidence is lacking, tax administrations may determine it based on available data and may choose other methods. The resale price method calculates the arm's length price by working backward from the resale price. It's ideal for marketing operations where the reseller has significant marketing functions. Key steps include determining the resale price, deducting a reasonable gross margin reflecting selling and operating expenses, and arriving at the arm's length price. Adjustments may be needed for product differences and business context. Transactional profit methods focus on profit distribution in controlled transactions. The transactional net margin method applies a net profit margin to determine an arm's length result, suitable when traditional methods fail. The transactional profit split method divides profits based on contributions, ideal for integrated activities. Both methods require careful consideration of contributions and adjustments for reliable results. The transactional profit split method allocates profits from controlled transactions based on each party's unique contributions and integration level and shared assumption of economically significant risks. It applies when reliable gross margin data is unavailable and all parties are at equal footing, and therefore focusing on actual profits and significant risks makes better sense. Profits are split as independent enterprises would expect, using factors or allocation keys reflecting relative contributions, ensuring compliance with Article 9 of the Organization for Economic Cooperation and Development Model Tax Convention. Profit-splitting factors are crucial in determining how profits are divided between associated enterprises. Asset-based factors consider balance sheet assets and self-developed intangibles. Cost-based factors focus on expenses like marketing and research and development. Other factors include functions performed and risks assumed. The selection must reflect an economically valid basis, comparable to independent parties' arm's-length transactions. Use of PSM should be sparse and carefully done. Better to consult TP professionals before using it. Selecting the right transfer pricing method is sometimes like using a decision tree approach. If reliable comparables exist, the comparable uncontrolled price method is preferred. Otherwise, look for using other traditional methods, such as RPM and CPM, based on functional analysis and level of reliable data available. For transactions with unique and valuable contributions, where business are high integrated and interdependent, and sharing significant risks, either jointly or separately, you may consider the profit split method, but exercise caution. If one of the transacting party is less complex, the transactional net margin method may be suitable. It is widely used, and there are several databases to help you with reliable comparable data. As a key takeaway, traditional transaction methods are preferred over transactional profit methods. The comparable uncontrolled price method is most reliable with strong comparable data. Consider transactional profit methods for unique contributions and shared risks. Ensure comparability between transactions. Conduct functional analysis and maintain documentation. Apply methods to approximate arm's-length pricing, considering independent enterprise perspectives. Consistency and high comparability are crucial, avoiding overtaxation or undertaxation. TP is not about one size fits all. Until next time, stay curious.